Okay, hi everyone. This is going to be the sort of summary lecture for the PowerPoint for Chapter 2. So again, these are just meant to be high level. I shoot somewhere between like a half hour to 45 minutes. Obviously, this isn't in lieu of coming to class, but I like to do these things to help you for when you study for the exam. So some of this we're going to go through quicker than other parts. And again, the idea is this is intermediate accounting. So you have already taken accounting classes. So this really should be a refresher for you. If you want more kind of like in-depth videos where it's like very slow, you can kind of unpack the journal entries one by one. Look at those sort of like financial accounting videos that I said are optional, right? Those come from like a sort of entry level class where you really take it slow. So in light of this being a summary video and that you've heard it, and seen it already in another class, let's kind of go here, shoot for somewhere between a half hour to 45 minutes. Okay, so what we're looking at in chapter 2 is the accounting process, right? And the idea with this, right, whenever we're talking about a business and financial statements, is we're really trying to capture economic events, right? Anytime we do a journal entry, we're taking something that happens in the real world and kind of converting it to a piece of paper. And when we have an external, or I'm sorry, an economic event, it can be external, right? Hey, we buy a car, engaging and using like a third party or another entity, or an internal event. Hey, we used some supplies this period. We accrued some interest this period. Okay. Now, obviously, right, when we talk about accounting, we're really talking about that fundamental accounting equation, right, where your assets equal your liabilities plus your stockholders' equity, shareholders' equity, same thing. We define these, right? We said assets are generally things the business owns, liabilities are things the business owes, and then stockholders' equity is kind of that residual amount that's left over, okay? And then they go through here, right? I'm not going to go through each one of these other to say then every time we have one of these kind of economic events and we have to capture it, right? We have to make it balance, right? Our assets equal our liabilities plus stockholders' equity, right? You can do this one of two ways if you were to analyze this, right? You could do like a plus on that side of the equation and a plus over there, right? That would make it balance, each go up by the same amount, right? That's what's happening here. You can do alternatively a minus on each side, right? To the assets and to the liabilities or stockholders' equity. Finally, right, you could do something like, let me make this a little bit darker color here. Is this green, right? You could do it internal to one side of the equation, right? Like if you were to buy a truck with cash, right? Debit truck, asset goes up, credit cash, asset goes down. It basically nets itself out. It remains in balance there. So you could do it on one side up and down, right? So it's like both sides go up, both sides go down, or one side kind of cancels each other out by going up and down, right? So these are various iterations, right? You can look at them. We're going to look at them when we get to that journal entry component of it. But you can see, right, this is like plus, 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 right, minus, minus, right? We're trying to kind of keep that seesaw. If you want to think of it like, right, like it's your assets equal your liabilities plus stockholders' equity. You got to always keep that in balance, right? And that's what we're doing in each of these situations. We're keeping it in balance, right? Here's a scenario where it's like one side of the equation, right? Like plus minus, that's going to cancel each other out. It remains in balance, right? And then here, there's minus, minus. So, right, when we talk about it, right, you always think of it kind of at that simple level where it's your assets equal your liabilities plus your stockholders' equity, right? Well, internal to stockholders' equity, you kind of have like your sort of common stock, your APIC, right? And then your retained earnings. And if you remember the retained earnings equation, right, from your kind of throwback days, right, it's your beginning retained earnings plus your net income minus your dividends gives you your ending. And if it was, net loss, you'd back it out. But the idea here is if you were to take that equation, right, one thing you could do is put it in a T account. You could memorize it as an equation, or you could kind of illustrate it this way where you have your retained earnings, your beginning, plus the functional equivalent of your net income or net loss minus your dividends gives you your ending, right? So that's kind of just building it out, starting it, right? So when we think of retained earnings, if you increase retained earnings, you increase stockholders' equity. If you increase common stock or paid in capital, you increase stockholders' equity, okay? So when we're talking about accounting, right, this is a double entry system, right? You're going to do your debits and your credits, right? You do it on both sides there. We're going to have accounts, right? Like cash, accounts receivable, accounts payable, right? You're going to have your general ledger, right? Which is essentially going to be functionally like all those T accounts, right? When you're, the collection of all of those accounts. And when we mention the T account, right, that's the idea with it there, right? So when we talk about accounting, right, every account, right, like cash, accounts receivable, accounts payable, right? If you think about it, right, it's going to have its own T account, right? If it's cash, that's going to be an asset, right? We're going to see this, right? Those increase with a debit, decrease with a credit. You're going to have, right, your beginning cash plus any you collected minus any you paid gives you your ending cash, right? For accounts payable, right, that would be a liability, right? So that means it's going to be the reverse. It's going to decrease with a debit and increase with a credit. You're going to have that same kind of framework. Your beginning plus, your additions minus your subtractions get you your ending, right? So where I'm going with this is every account is going to have a T account. And internal to that count, right, it's going to kind of follow that base formula, right, where it'll be your beginning plus your additions minus your subtractions gets you your ending. And a lot of times with accounting, right, they can test you or they can make you kind of back into it in the middle, right? They may say your beginning cash was this. During the period, you collected this amount of cash. At the end of the period, we had this amount on hand, right? So you'd have to solve for the subtractions, right? Imagine, normally you think like assets equal liabilities plus stockholders' equity, right? Like 100 equals 70 plus 30. They teach it like this, where it's like, one side of an equation, right? So it's like, you think you're solving for your ending always, right? But they could really hit you up on any variable in there, all right? So this is kind of, building on that framework, right? Debits on the left, credits on the right. It's always going to be a debit on the left. It's always going to be a credit on the right. Every single T account. Don't complicate it anything more than that. What causes an account to increase or decrease depends on the type of account. If it's an asset, liability, or stockholder equity account. But internal to it, every T account, debits on the left, credits on the right. Okay? And this is basically just saying right here, right, when you do it, right, your assets equal your liabilities plus your stockholders' equity. Assets increase with a debit and decrease with a credit. The reverse is for stockholders' equity or for liabilities and stockholders' equity account, right? And sort of the other thing to be aware of with this is if you remember stockholders' equity, that includes your net income, right? Remember we talked about this. If you have in your net income, that's going to include your revenues and expenses, right? So if you think about it, if you increase a revenue, that increases your net income, which increases your retained earnings, right? So that is why you credit revenues. You're generally going to credit a revenue. The reverse is true for expenses, right? If you increase an expense, that decreases your net income, which decreases your retained earnings, which decreases your stockholders' equity, right? That's a big, long logic chain of basically saying when you would incur an expense, you debit your expenses, right? So again, this should be a refresher for you, just kind of going through here. Again, here they're mapping it out, they're balancing it, but they're using T accounts, right? So, you can see, right, the debits in this case, right, they're going to have 40,000 debits are going to equal the credits, right? So here they borrowed money from a bank, right? They got money, that's more cash. We know with cash, that's an asset. So it's plus minus. Notes payable, it's a liability. That's minus plus. Well, after this, they have more cash, debit the cash. After this, they have more note payable, credit the note payable, the seesaw balances, right? So this is just kind of showing you the setup with it. Again, remember we said the general rule is you're going to debit your assets, debits increase your assets, credits decrease them, right? So plus, minus, and then over here, it's minus, plus. But we talked about expenses and revenues, right? Revenues you generally credit because you're increasing your stockholders' equity. Expenses you generally debit because you're decreasing your stockholders' equity. It's a little bit like looking in a mirror and like trying to rub your head and pat your belly at the same time, right? Sometimes this stuff gets confusing. The more you work with it, the more you see it, the more it'll kind of come into play there, okay? So we talk a little bit about accounts here, right? We have to distinguish our permanent accounts, which are going to be our balance sheet accounts, namely our assets, our liabilities, and our stockholders' equity, from our temporary accounts, namely our income statement accounts, right? So the idea with this is every period, right, we record our journal entries. We kind of follow the steps that we go through. And then once we're done preparing the financial statements, we close out all of these temporary accounts. So all the expenses, you close them out. All the revenues, you close them out. You basically package them a nice little bow and you put them into retained earnings, which becomes part of your shareholders' equity, your stockholders' equity account. Okay. So again, they're giving us an MCQ here. You can look at that. Then really what they're saying, hey, we have this kind of Lion King circle of life, the steps in the accounting process, right? How do we go and we prepare these financial statements? What's the steps, right? Well, essentially what you're going to do is, you're going to be given like a pithy statement, which we've kind of been looking at. You're going to record that, right? So do the journal entry, right, which is going to be probably there in your general journal. You're going to kind of then transfer that over to your general ledger. Then you're going to do an unadjusted trial balance, do your AJEs, right, your adjusting journal entries to kind of get everything up to the proper balances at the end of the period. Then we do an adjusted trial balance, right? It's unadjusted, make the adjustments, do an adjusted trial balance. Use that to prepare the financial statements. That's great. Then we close out those temporary accounts, right? We kind of package them up and put them into retained earnings. And then finally, we prepare a post-closing trial balance, which if we closed out the temporary accounts, that's going to leave only our permanent accounts, right? Our assets, liabilities, and stockholders' equity. You won't see any revenues or expenses on that post-closing trial balance. Okay, so they're giving us kind of the steps here. The first thing is you need to look and see, was there an economic event, right? This will be pretty obvious. It will be kind of, a pithy statement. We bought a car. We did this, right? You need to make sure you look at that, read it carefully. Then you do the transaction analysis, right? Where you make it balance, the seesaw, right? So here it's kind of just showing you, again, we've seen some of these, how you would do it. Transaction 1, transaction 2, 3, 4, right? You can see we're kind of running a total there, right? When we're building up, it's cumulative, right? If you look at it, right, we start here with cash of 50 from the first journal entry. Then in the second journal entry, right, our cash looks like it's increased, right? So it's like a running total, right? That's how you kind of build out these T accounts as they go along there, right? So more journal entries, more journal entries. And do be aware that when we do this kind of general journal, right, that's going to be chronological as these happen. 1, 2, 3, 4, 5, right? You kind of just do it as it happens, and then you'll carry that over into the general ledger, which is essentially all of those T accounts, right? So it's like you do a journal entry here, debit X, credit Y, right? You would carry that over to the X account. You would carry that over to the Y account, right? That's kind of how we were building out those T accounts there. And you can have specialized journals, right? Maybe one that's just looking at your sales. Right, so let's look at some of these. This is more what I would think that's important because we actually need to record the journal entry. Right, so we're in intermediate accounting. Right, the idea with this is it's kind of like doing journal entries. It's like learning to read. Right, when you first start to read, you do kind of like syllables, like the dog, right? You pronounce it out. That's normal. That's natural. You only learn kind of through that like little bit at a time. Right, that's the functional equivalent of doing that transaction analysis where it's like plus, minus. You should be at a point in this class where you get a little pithy statement like this, and you can do the journal entry. Right, so we're going to run through some of these. Right here, we borrowed $40,000 from a bank. We signed a note payable. Right, debit cash 40, credit note payable. Our total debits equal our total credits. Hey, we're good. They're then giving us a series of transactions, and they say, can you kind of, go through these, right? Starting at July 1st here, kind of move down and do some of the journal entries. Okay, sure, not a problem, right? So we have 2 individuals who each invested 30 grand. So, 2 times 30, we're looking at 60,000, and they got some stock, 3,000 shares of stock. Okay, so this is from the business's point of view, right? We got cash, debit cash. We issued stock, credit common stock. Our total debits equal our total credits. Hey, we borrowed $40,000 from a bank and signed 2 notes, right? We got cash, debit cash. We now have more liabilities, credit note payable. Sort of like academic / practice tip. Anytime you're doing a journal entry, always start with cash first, right? If you can kind of pluck cash in there, you can maybe sometimes force it to balance otherwise the rest of the journal entry. It's not like the right way to do it, right? Like you should ideally understand what you're doing, but sometimes these can get complex and it's just like, well, do what I know first. I know the cash is this. I know the cash is that. I know I debited, I credited. I know this equation has to balance. Let's see if I can kind of just figure it out from there. Now, one of the things with this that we're going to kind of come back to is do be aware, right, that they're charging interest on this note. So we may have to calculate the interest expenses in AJE. Okay. Here, right, we paid our rent in advance, right? Debit, prepaid rent. That's an asset. Sometimes it's called a prepaid expense. Credit, cash, right? At the end of the period, we may make an AJE for this if we used some of that. Here's a simple one, right? Bought office equipment, paid cash. Debit office equipment, credit cash. Here we bought some inventory, right? Debit inventory, credit account payable. Now, one thing with inventory is there's 2 systems you can have, right? Your perpetual inventory, which is kind of continuous, right? Every time you buy, you sell, right? You return your inventory, you're going to make a journal entry for it. Whereas with your periodic inventory system, you really wait until the end of the period, right? Here, every time it's involved, we're doing the journal entries, right? With periodic, we wait until the end of the period, we kind of do a count of it, and then we can determine our cost of goods sold, right? If you remember those kind of FIFO, LIFO type things, that you can use it as a kind of like a grand total. You also can use FIFO and LIFO and a perpetual, but just kind of mapping this out at a high level, right? So let's kind of continue here. We bought some supplies with cash, right? Debit supplies, credit cash, not a big deal there. Here, right, we sold some inventory. You know, we're using the perpetual inventory method, which means we're going to do the cost of goods sold at the time of sale, right? So here we have, a sale of inventory. So this means 2 journal entries. Journal entry 1 to record the sale. Journal entry 2 to record the cost of goods sold, right? So we sold it for 35. Remember, start with cash, debit cash, credit revenue. And then our cost of goods sold, which is an expense, literally read that word for word, the cost of our goods are we sold. I'm sorry, I can't even read it myself. Cost of goods sold, right? The idea with this is we look and we say, what did we pay for it? In other words, when you buy inventory, right here on the timeline, you do not take the expense when you buy it. Instead, you wait until you sell it to take the expense, right? We're trying to match the revenue with the expense. So that's the idea, is cost of goods sold reflects what you paid for it. You take the expense when you sell it. Here in journal entry 1, we sold it. Debit cost of goods sold and expense, credit the inventory. In short, put it on the balance sheet here when you buy it, get rid of it and expense it later on when you sell it in journal entry 2. Okay? This is just another iteration right here of the sale of an inventory, so you can look at that one, right? Here, a little bit interesting, right? We got paid, imagine we're a landlord, somebody paid us ahead of time for their rent, right? So in this case, right, we got cash and we have deferred rent revenue, right? This is a liability. Sometimes it's called unearned revenue, right? So we tee it up as a liability, and then we'll see later on, to the extent we earn that rent revenue, we're going to flip it out and get rid of it, right? So some of these kind of, the deferrals, the accruals we see on here, you just put it on up front, and then as you incur the expense, as you earn the revenue, you record it. Okay, here we sold something. I'm sorry, let's see what's going on here. Paid somebody clothing, $25,000 on account, right? So, hey, we owed them money before. Maybe we bought something from them and we owed it, right? It would be like, hey, I'll pay you later. And now we're paying them, right? So we paid cash and then we got to get that liability down, right? It's like we paid off our credit card almost. That liability, when we debit it, makes it go down. Here, right, we have salary expense for our employees, debit salary expense. We paid it in cash, credit cash. Here, right, looks like we received $1,500 on account. So if somebody comes in and buys from us here, or let's see what's going on. We received $1,500. So somebody comes in, they buy something from us, and they say, we're going to pay you later. Here's the kind of the flip side of that, when they pay us later. Right? So we got cash, we got to get rid of that receivable they owe us. And the last one, we owed somebody money and we paid it off. So payable. Here, somebody owes us money, the receivable, and they're paying us off. We got to get rid of that receivable. Okay. Next one, we pay a dividend, right? So remember that retained earnings equation, beginning plus net income minus dividends, right? So the idea is, when you have an increase in dividends, that's going to be a decrease in your stockholders' equity, right? That's why you debit it, right? You debit dividends. So here, debit dividends, we paid it, credit cash, debits equal our credits, that's fine. They give us some MCQs here. You can look at those. This is just showing the interaction between the general journal, right, where you do it chronologically, right, as it happens, 1, 2, 3, 4, and then the general ledger, right, where it's going to be all those T accounts, right? We make the journal entry, we carry it down. We make the journal entry, we carry it down. Right, so the idea with this is Once we get our general ledger, right, if you look at cash here, right, you're going to have your beginning plus your additions minus your endings, right? If you were to try to just like trace those numbers down, your ending here would be that guy, right? So that's how the assets work. Your beginnings on the left, your endings on the left, assuming it's a positive balance. Your payables are the reverse, right? Because that's a liability, right? So your beginning is going to be over here, right? So you increase it on that side, decrease it over here. When you kind of snake through, your ending is going to be over there. Kind of looking like John Madden drawn on a football TV screen right now. But again, this should be review for you guys. So I'm not like, trying to like do super in depth on this. Right, so this is just saying, hey, you would post it from the journal to the general ledger, showing you, hey, when we pluck those out, right, those accounts, some of them we're going to use to prepare a balance sheet. Some of those we're going to be preparing an income statement and stockholders' equity. Right, whenever you do that, right, so we're kind of going to the next step here, right, from our general journal to our general ledger, right, then we have our unadjusted trial balance, right? This is basically just a big giant T account where your total debits are going to equal your total credits, right? So that's what this is showing right here. Hey, we have all those T accounts over there, right, that we saw before. We have the ending balances. Some are debits, some are credits. We take them, right? We kind of plug it in, all the debits, all the credits. Hey, they equal each other, right? This is kind of one of the cool things with accounting. It's like every time you do a journal entry, it has to balance. That's like the microcosm. The macrocosm is it ultimately makes the trial balance. Okay. So we've done that, right? We're kind of plugging along here during the period. We're recording the journal entries as they happen. We do our unadjusted trial balance. And then here we are at the end of the period. We need to, for these prior entries, right, record our revenues that we've earned, record our expenses, right, that have happened. In other words, we have to get our accounts, now here we are at the end of the period, up to their proper balances, right? And that's why we're going to make AJEs, right, adjusting journal entries. And really, right, whenever you talk about them, right, so you have your prepaids, and your deferrals, right? Your accrued and your deferrals. And really what they're saying here is with these guys, with your prepayments, the setup here is, and they're known as your deferreds, right? Your deferred. If you think about it, right, you are going to have, and this is what it says here, occurs when the cash flow, you're going to have cash first, then take the expense later. Accruals, which we'll see, are also part of an AJE, or the reverse. It's like expense first, you pay the cash later. So what's something like this? This may be like prepaid insurance, right? We spend the cash up front, buy insurance, and then here we are at the end of the period. We use 2 months of it, then we take the expense for it. Okay. Right, so this is just kind of showing you, right, we acquire it in one period, we expense it in the future, we buy the insurance in period 1, maybe we expense it next period, or partially at the end of this period to represent its usage. Right, so then they're giving us some setups here of AJEs. So let me kind of look down here and see if they're going to how much of this they're going to unpack. So again, we're going to look at this high level here. So what's going on here? We bought some supplies during the period. Here we are at the end of the period, and we used some of those supplies, right? We got to account for the expense with it. And oftentimes, right, remember I said they have that kind of like base formula? What happens here is your beginning, what you bought, you're at the end of the period, right? Here we are, we go and we count our supplies. So it's like, if we know we started with this 0 and we bought 2,000, and then here we are at the end and we only have 1,200 left, that means we must have used 800, right? It's kind of like cookies in a cookie jar, right? If you buy a box of Oreos and there's supposed to be 100 Oreos in there, and then you're at the end of the day and you have like 60 Oreos left, then you must have ate 40 Oreos, right? I don't recommend eating that many Oreos, but that's the idea there. You got to back into it. That's what I was saying. It's not always solving kind of just that ending balance. It's somewhere in between. Sometimes you got to back into it. So in this way, right, to record that expense, we're going to debit supplies expense, reduce supplies. Here's that rent, right? The idea, it looks like what's going on here. We prepaid some rent, then we used it, right? So it looks like we must have used, in this case, 2 months, right? So we're going to take rent expense. And then that asset we put up there, the prepaid rent, we're going to knock it down, right? The next one here is depreciation, right? So the idea with this is when you buy an asset, right, you do not immediately expense it. Instead, you have to capitalize it, put it on the balance sheet, right? So like debit machine, credit cash, right? Or whatever it is you pay for it. And then, right, later on as you use it, you're going to depreciate it, right? This guy right here, this is a deferral in the sense that, we pay the cash up front, but we take the expense later, right? And we'll talk later in this class about more advanced depreciation things, but it's a matching concept, right? If you buy this for $100, right, it's going to last 10 years, then you're going to maybe every year take $10 of an expense, right? We're matching the expense to the time where we're generating the revenue. Right, so there's an MCQ you can look at. Here's an alternative approach, right? If you want to kind of back into it in an alternative way, that's great. On the flip side, right, of our prepaids, right, we also have, in this case, our deferreds, right? So this is where cash is received from customers in advance of providing a good or service. So let's look at some of these here, right? So in this case, right, it looks like they paid us the rent in advance, right? So whenever we're looking at our deferreds, right, this is going to be cash first. And then, like we said, right, it's expense later or revenue later, right? Recognition later. So in this case, what happens is, right, they paid us up front from that earlier journal entry, like, 15 minutes ago in the lecture, the money in advance, right? We said that's a liability. We credited deferred revenue. Now, here we are at the end of the period, and, we've earned some of that revenue, right? It looks like $250. So we credit rent revenue, we debit, we knock down that balance for the unearned revenue, right? Here's an MCQ. You can look at it. Again, it's just kind of showing you there. Sometimes you kind of have to back into these things, right? And again, here's an alternative approach if you want to look at that. Now, when we have accruals, right, this is the reverse setup, right? With the accrual, we have the recognition first, right? So we're going to have our expense or our revenue first, and then later on, we're going to pay or receive the cash, right? So it's the flip side of your deferreds, right? So you have deferred, which is it's deferred. Later, you take the expense, you recognize the revenue. Accrual, now you recognize the expense or revenue. Now, right, so if we look at some of these, right, you can have accrued liabilities. Here's sort of an example, right? Hey, we have some salary expense that we've incurred this period, right? We'll take the expense now, debit salary expense, credit payable, right? So it's kind of like expense now, right? That's our AJE at the end of the period. right? We're at the end of the period, we got to accrue that up. And then next period, right, we're actually going to pay that, right? If it was like, then it would be the flip side of that. It would be debit salaries payable, credit cash, right? Here we have interest payable, right? Remember we said we borrowed that money. Now we got to accrue the interest expense that happened during the period, right? So we borrowed 40 grand, 10% rate. Looks like 1 month passed, right? And it's a 12% or 12 months there, right? This is based, why is it over 12, right? Because this is based on an annual amount, 12 months. So we got to keep it there to have it apples to apples. All right, so we would debit interest expense, credit interest payable, right? So the idea with this is expense now, later on, next period, we'll pay that out, right? So this is the idea here. We got to make that AJE at the end of the period, right? So there's an MCQ on interest expense. You can check that out. We also can have accrued receivables, kind of similar setup here. We're going to have the revenue first and then the cash later, right? So here's an example, right, of an accrued receivable. So interest revenue, right? Hey, we, looks like Dress Right loaned another corporation $30,000. So we're on the flip side. We're getting the interest income now instead of paying it, right? So we run the numbers on it. We're going to do debit interest receivable, credit interest revenue, right? So we have revenue now, and then, hey, maybe next period, they're going to pay us. So it's recognition first, cash second. Some things here, right? You can look at this depreciation and bad debt expense. Those are going to be based on estimates, right? So once we get our unadjusted trial balance, right, that big T account where the debits have to equal the credits, we make those AJEs to get everything up into play, and then we do our adjusted trial balance, right? It's unadjusted, we adjust it, and now it's adjusted, right? It's like it's broken, we fix it, now it's fixed, right? That's going to be the same thing shown over here, where it's at the bottom, right? So here's our unadjusted, we make those AJEs, and then we get our adjusted trial balance. Once we get that, right, we prepare the financial statements, right? We're going to start here with the income statement where it's generally going to show for a period of time your revenues and expenses, right? It's broken out very specifically there. There's like a multi-step income statement, but for this being chapter 2, right, you can think of it like your revenues minus your expenses get you your net income or your net loss. It's for a period of time. And you can also have your gains or losses there from sort of peripheral activities, but just keeping it high level for it. We will talk about a statement of comprehensive income, right? So it kind of builds out that income statement a little bit further. It's more comprehensive. We're looking at sort of other items that you wouldn't traditionally put in an income statement. And you can do this 2 ways, right? You can have a single statement, right? Like your income statement here that kind of runs all the way down and calculates your comprehensive income, right? So we're going to go from like net income to sort of our comprehensive income there, or our other comprehensive income. Or you can do it in 2 statements, right? Where it's an income statement where you get your net income, and then you have a second statement that is your comprehensive income statement. Essentially, you carry that net income over and you get it down to that comprehensive income, okay? So the balance sheet, right, when we talk about this, when you're examining it, it's your assets equal to your liabilities plus your stockholders' equity. The line of demarcation here, right, internal to each one, at least the assets and liabilities, is the 1-year mark. In other words, do we expect in general, with regard to our assets and our liabilities, to use the asset or settle the liability within the next year? If so, it's a current asset or current liability. If not, it's non-current. And the more specific exact thing we're looking at is at 1 year of the operating cycle, whatever is longer. So you would kind of draw out 1 year, you would draw out the operating cycle, like map it out, which one's bigger, and that would tell you kind of the line of demarcation. We said you don't fit into that kind of category. You're going to have your non-current assets and your long-term liabilities. So something like PP&E, right? That would be a non-current asset. Long-term liabilities, so on and so forth. So this is kind of just showing you that, right? Here's a balance sheet. When we're talking about a balance sheet, this is at a point in time, right? So it's like right here, a point in time. It's not where an income statement, right? An income statement is for a period of time, like 6 months, a year. This is showing it's like a snapshot. Where are you at this point in time, right? So we'll have our current assets, our non-current assets, our current liabilities, our long-term liabilities. And you can see, right, it balances, right? Your total assets equal your liabilities plus stockholders' equity. Okay. The next one here is the statement of cash flows, right? So this is going to be basically your beginning cash plus or minus your inflows, right, is a plus, your outflows are a minus. Those cash flows from operating, investing, and financing activities. And we'll talk about this, right? But operating is related to basically your operations, right, when you're determining net income. Investing deals with like long-term assets and non-operating investments. And then financing is really when you're like financing the business, right? You're dealing with like creditors or owners, right? We're really examining cash, right? So here's that kind of setup, right? We have our cash flows here. We have the operating, the investing, and the financing. When we kind of run the numbers on that, the negative and the positive, we have a net increase in cash of 68.5. Then we have, our statement of shareholders' equity, right? So remember we said stockholders' equity or shareholders' equity is kind of broken out between common stock and retained earnings, right? When you're dealing with common stock, right, that's going to be your beginning plus any stock you sold, minus any stock you bought back, right? So generally net income and dividends aren't going to be even though they build it out this way, you're not going to really see anything there. Same over here for retained earnings, right? So you can think of it like they each have their own equation in it. Common stock is your beginning plus what you sold minus what you bought back gets you your ending. Retained earnings is your beginning plus your net income. Oh, by the way, we can nab that from the income statement. Minus our dividends gets us our ending. Okay, once we prepare those financial statements, right, the next step is we're going to have to close out the temporary income statement accounts, right? So what we're really doing here is, you remember we said normally you debit an expense and you credit a revenue, right? So I don't know, say we had 100 in revenues and 80 in expenses, right? What you do here is you reverse it, right? You debit your revenues, right, 100, so we can get that off the books, that temporary income statement account. You credit your expenses, 80, right, so we can get that off the books. And then, we got to make this balance, right? The difference there we can hit retained earnings for, right? That's functionally our net income, right? We're taking our revenues and expenses. It's ugly, right? We have all these revenues, all these expenses. We're going to consolidate it, just the net income, plug that into retained earnings, right? And why we do that, right? Because remember, it's beginning retained earnings plus net income. It's also minus net loss. If you happen to run into a loss, right, you would debit retained earnings there. But that's why you credit it, okay? So this is just kind of showing you this, right? In this case, right, here's some examples of doing that. closing out the dividends. Again, here's that retained earnings, right? We have our beginning plus our net income minus our dividends gets us our ending, okay? And then finally, right, once we close out all those temporary accounts, right, so all our revenues and expenses are now gone, right? The only thing we're going to have left is our balance sheet accounts, right? Our assets, our liabilities, and our stockholders' equity, right? So we're going to use that to prepare a post-closing trial balance, right? You're not going to see any revenues or expenses here. We close those out into retained earnings, right? So they're kind of sneakily hidden, put on there, but that's really what we're showing on this post-closing trial balance, just our permanent accounts. Now they talk a little bit about here from, hey, we're talking about cash to accrual basis. Sometimes you might need to convert, right? Remember we said the general rule here is going to be for cash basis, cash in is a receipt, cash out is a disbursement. You kind of think of it like revenue and expense, but with different terms. Whereas for accrual, right, it's whenever we earn the revenue, we credit it. Whenever we incur the expense, we debit it. So here's an example where you might need to convert. They give us some information here. Suppose a company paid $20,000 in cash, right? So that's a cash outflow there of 20 during the period, and you determine there was $5,000 in prepaid insurance at the beginning. Can you please figure out the insurance expense for the year? So this is just that base formula, right? We figure out, right, base, beginning plus additions minus subtractions gets us our ending. They're giving us these three things, and then we got to back into solve for our insurance expense there, right? So we're saying, hey, for cash basis, we know it's $20,000. That's great. That would be sort of the cash outflow for cash. If you wanted to know it for accrual, you got to plug what we know into the sort of formula for it, that base formula, the T account, and then back in, and you would say, oh, it's 22 for accrual. Right, so here's another thing, right? Same kind of setup there where you can look at the salary expense. You're going from, hey, we paid $150, but we got to use that base formula to back into the salary expense for accruals. And again, we're looking at salaries payable here to kind of, help us figure this out. And you can see that journal entry balances there. Okay. So this is just showing you that in T accounts, things, how you would convert from cash basis to accrual, right? For assets, you're going to add increases and deduct decreases. For liabilities, you're going to do the reverse, right? Deduct increases and add decreases. Right, here's an MCQ you can look at. They talk a little bit about a worksheet here, right? So this is just showing you, hey, how would you do this if you saw it in an Excel, right? So you start with the unadjusted, you make the AJEs, that gets you your adjusted, and then you prepare the financial statements, okay? A few other things here, right? You can look at these, adjusting entry when a reversing entry is not made, right? So this is just showing, hey, here's an alternative. If you don't want to make that reversing entry, here's kind of another way you can look at it. They talk here at the end a little bit about a subsidiary ledger. So this is just saying, hey, if you looked at the the accounts receivable T account here, right? You could see like it's your beginning plus, right, any more sales on account at $32.95. You got to be aware sometimes when they have a subsidiary ledger, it's like a ledger within a ledger, right? Instead of doing like 1 million transactions and making our journal real giant, we'll just kind of back this out, put it in a separate T account where we just calculate all our specific receivables, like the high school owes us money, these people do, and then we'll total that and then kind of make it a little bit cleaner for our journal there. All right, so this talks a little bit more about specialized journals, right? You can have these for like maybe cash receipts, cash disbursements, purchases. Right, one that might be very common is the sales journal, right? So this would basically be used to record your credit sales. So again, this is just kind of showing you that, an example of a sales journal, another setup there. You could have a cash receipts journal, right? That's really just looking at, your cash in that way, right? So here's an example with some of the cash. So with that, right, we're kind of butting up against the amount of time that I want for these. But, look at the problems. We will kind of pick it up from here as we go into it, okay?